Okay. So cost of investments. Don't forget the cost of investment can be cash payments, can be share consideration, can be deferred consideration, can be contingent consideration, and loan notes, or the combination of above. So whether I've gotten my cost of investment, we add NCI to it. Don't forget NCI can be valued in two ways. Either it is fair value or share proportionate. Then this will give me the purchase. Then I will now less the net assets. This will give me goodwill. Or goodwill or gain on again, which one has negative goodwill. This is what we have done. Now, let's take one more question. On this, we will now go to cost of investment. How do we calculate a group account question? We now take the proper group account and take it. Okay. That's what we are going to do. Okay. Let's take question on Ichoke Nigeria Limited. Ichoke. Let's check Ichoke Nigeria Limited.
Sorry, sir. What question about what, sir?
We are seeing on the calculation of goodwill. Ichoke is number what? How to calculate goodwill on it. It shows in number 3 question. Question number limited. Question 3 on page. I don't know whether you have seen it.
Yes, we have seen it, sir. I've seen it.
No problem. The question says it shows prepare a consolidated financial statements. 30th September each year. 30th September each year. Good. What is the question? The requirement says calculate the goodwill to be recognized using both method and treatment of impairment in both method. So there are 2 methods to calculate goodwill.
Which number again,
Sarah
please?
use the fair.
Number what,
Sarah
please?
use.
The question.
Question 3, goodwill.
Okay, sorry, please.
Sarah will use fair value method or share proportionate method. What are the indicators? That means when SI can be valued using fair value method or share proportionate method. What are the indicators of value? What am I going to see in the question that will warrant me to calculate fair value? 1, you must provide me market price per shares of subsidiary or NCI. 2, you must give me the fair value of NCI. 3, goodwill attributed to NCI. And 4, fair value of the whole subsidiary. One of the 4 must be in the question, either with or without the group policy. One of the 4 must be in the question. But if it is share proportionate, how do I know when the question is silent? What do we mean by silence? When it does not tell me how to go about valuing NCI, then company policy will tell us it is share proportionate. Okay. So let's take this question. Ishok Limited. Ishok. The requirement says Ishok. I should calculate goodwill using fair value and share. So the treatment of impairment in both methods. So goodwill. This is fair value. The same formula. Say cost of investments. Add NCI. This will give purchase consideration. I will less the net assets at the date of acquisition. Then I have my goodwill. And for the next one, this is the share proportionate goodwill. See the same formula by saying cost of investment, add NCI. That will give me purchase consideration. I will not less the net assets at the date of acquisition. That's giving goodwill. Purchase bargain. So let's start now. So about that. When starts reading the question. Ishok acquired 70% equity shares of Yearflow. Ishok acquired 75%. Ishok acquired 75% The group structure, parent is 75. And NCI will be 25% based on the question. I get control of Airflow. Airflow has 12 million equity shares. So the share capital of the company is 12 million. So if there is a 12 million, we can analysis of the shares is subsidiary. One, parents acquire 0.75 times the total number of shares, 12 million. That will give me 9 million shares. And NCI will have the remaining. NCI has 25%. Which is 3 million. That is it. So after this is done, based on the question so far, the details of the purchase consideration as follows. Don't forget to acquire confession issue shares for every 3 shares acquired in inflow. Therefore, 2 for 3 is not talking about the cost of investment. Okay. Cost of investment. What do I need to know for exam purpose for share consideration? Share consideration can be tested in 2 ways. In 2 ways. Share consideration can be tested in 2 ways. Best way when they give exchange ratio,
Sorry,
the
your audio
question
is
will
bad.
supply me exchange.
The audio is bad.
Huh?
The audio is very bad.
Which audio? My own? Or
Yes,
from
it's
your own
coming in.
end?
Yes, sir. You are honest. No, we are not clearing, sir.
It's off and on, and it's cracking.
Yes, sir.
Somebody should confirm the claim to me. Is that true?
Yes, sir.
Yes, sir. Yes, it's true.
Confirm.
We can hear you, sir. Well,
Why people now? Okay, let me log out. How far? Is it clear now?
yes, sir. It's clear now.
Is it clear?
Yes, it's clear.
Thank Share consideration. How can it be tested in exam? It's 2 ways. First way is to give exchange ratio. Second way, issue direct. But what are the things to know? Things to know when it is share consideration. 1, it must be issued at the market price per shares of the parent. 1. At the market price per shares of the parents. That is the first one. Second one, if the market price per shares of the parents cannot be determined in a question, then market price per shares of subsidiary should be used. Three, the accounting entry to raise cost of investments. The market price per share, the cost of investments will be debited. Equity shares will be credited, and share premium will be credited. It is 2 credits against 1 debit. That's all.
Sorry, sir, you said what? Equity shares and
Fourth one, I think somebody wants to ask a question at that time. If there is no share premium
Sir, we can see you, sir.
Can't see your page.
in the accounts of the parents,
So we can't see you.
we can't see your
share
screen.
premium account will be created.
Can't see your screen. Oh.
Okay, I'll call and let you. Can you see my screen?
Yes, sir.
Yes, sir.
So if there is no share premium in the account of the parents, share premium accounts will be created. This is what is must know by you. But for this, provided it has not been recorded, for the accounting entry, provided it has not been recorded, that is it. Any question? So let's go to the question now. The question says, for every 2 shares he has given an exchange ratio, he used share consideration. Say for every 2 shares, exchange ratio has been given. So 2/3 times, how many shares does he acquire? 9 million. 2/3 times 9 million give us here. Don't forget, it must be issued at the market price per shares of the parent. I will ask the question. I need the market price per share of the parent. I would now say, okay, cost of investment. Give me the market price per share of the parents. Cost of investment must be debited.
6 naira 50 kobo.
6 million times 6 naira 50 kobo. What does it give us?
39 million.
So the cost of investment is 39 million. Using share constitution. So times 39 million. Equity shares will be credited by saying 6 million times the nominal value, which is 1 naira. In case it is not given, I will assume it is 1 naira. That will give me 6 million. Has it created a premium? Yes. Share premium. Will be credited. We'll say 6.5 minus 1 multiplied by the 6 million shares. That will give me 33 million. Don't forget the accounting entry. I will debit my cost of investment. Credit, credit. It is 2 credit against 1 debit. That is it. But that is not all. They give me the market price per share of subsidiary. It's an indicator that NCI is valued at fair value. So I can do that quickly. Because how do I know it is fair value? 1, you must give me the market price per shares. So to add NCI, 3 million shares times 6 naira. Because I'm seeing in there 6 naira for the subsidiary. So 18 million is the value of NCI when it is fair value. I'll quickly do that to get my mark. Still continue. On 31st December 2004, it showed we make a cash payment. Don't forget the acquirements of January 2004. But he said on 31st December, it showed we pay a cash payment of 7.1 million, 7.15 million. That is 7,150,000. So the former shareholder of Airflow who sold their shares to Show Limited. On 1st of January, the cost of capital is estimated to be 10%. So he has given me the cost of capital to be 10%. What type of consideration is this? This is deferred consideration. How do I know it's a deferred consideration in exam? It is going to be paid in a future date. The amount you want to pay in a future date, I need to discard it to the present value of today. Deferred consideration. It's one of the ways a parent can acquire a subsidiary. Don't forget, deferred consideration cannot stand alone. So, how do I do? Or say present value equals to future value bracket 1 plus R or raised to minus N. What is PV? Present value. Then FP, the money he wants to pay in a future value. At what rate, which is the cost of capital, cost of doing a business. Then N is the numbers of years, which range from the date of acquisition to date of payment. But don't forget, there's one trap they used to test in deferred consideration. When are we consolidating? Which is also tested in this question. So I can put it into the formula now. But don't forget the accounting entry when there's a deferred consideration. What is the accounting entry when there's a deferred consideration? See, the present value of a deferred consideration will be debited to cost of investment. Then the parent will suffer the finance cost. Finance cost will be debited to who? Retain any of the parents. Is one who wants to acquire, he does not have money. Then I'll create a liability. If I'm consolidating under 1 year, current liability, more than 1 year, non current liability. So it's either going to be non current liability or current liability will now be credited. It is 2 debits against 1 credit. That is it. How do I know it's a deferred consideration? I'm going to pay in a future date. So let's go to this question now. This question says, deferred consideration. What is the present value? We don't know. The future value says it's going to pay 7,150,000. At what rate does he say he wants to pay it? At what rate? Say 10%, which is 0.1. The numbers of years from the date of acquisition to date of payment. The date of acquisition is 1st January 2004. And it's going to pay 31st December 2004. So from date of acquisition to date of payment is 1 year. Then when do we ask me to consolidate? From the date of acquisition to date we are consolidating is 9 months. How do I get that? Date of acquisition is 1st January 2004. And we are to 30th September, date of consolidation 2004. That is 9 months. With this now, I can now put it into the formula to get the present value. I can now put it into the formula to get the present value. So the present value equals to future value bracket 1 plus R corresponding. So present value equals to 7,150 bracket 1.1 plus 1 minus 1. What is the present value? Somebody should check for me. Help me with the calculator. What is the present value? What is the present value?
6,500,000.
6,000,000, 6.5 meter for you. 6,500,000. Thank you, my sister. So I need to determine the interest. We say determination of the finance cost, which is the interest element. How do I go about that? I will apply the formula by saying present value equals to future value. Future value equals to present value plus interest. What is future value? Equals to present value 6.5 plus the interest. If I collect the lifetime, 750,000 minus 6. How much is the interest now? So the interest element, the interest will now equals to, what is the interest?
650,000.
650,000. Don't forget, this is for 1 year. This is for 1 year. So 650,000, forget 9 months. 9 months interest will now be 650,000 times 9 over 12. That's all. So 650 by 6, I'll give me 57.
487,500.
Thank you. So the accounting entry to raise now will say present value. The accounting entry to raise, the accounting entry to raise will not be present value debit to cost of investments, which is how much? 6. Then the finance cost, which is going to be debited to TNE, 487,500. Then the liability under current liability or credit, which is 6,987. That's all. That is all for the different consideration. Any question before we proceed? Any question before we proceed? Any question before we proceed? In the absence of no question, let's proceed. Say on 31st of December 2004, Ishok will make a cash payment. No. On 1st January 2005, Ishok will make a cash payment of 30 million to the former shareholder of Inflow, the shares to Ishok on 1st January 2004. The payment is contingent upon revenue growing by 15%. My brothers and sisters, what type of consideration is this? It is known as contingent consideration. How do I know in exam is contingent? What am I going to see that will indicate to me that is a contingent consideration? When there is a clause, a condition. If I tell you that if you pass on your paper, I'm going to give you 100,000, it's a contingent consideration. You have not written the exam, it's a contingent consideration. So my brothers and sisters, what do you need to know about contingent consideration? Let's do it here. No. What do we need to know about contingent consideration? In contingent consideration, contingent means it depends. contingent consideration. 1. There must be condition. That is the first, like this question say, growing the revenue by 15% condition. What are you going to do in return for meeting the condition? It's known as 2. It said that they say fair value of the contingent consideration, or they say the fair value of the arrangements. Watch out for those words. It's always there. These are the two things they can say. Shall they give us the fair value of the contingent consideration or fair value of the arrangement? Like this question, what is the condition? Say growing the revenue by 15%. What is he going to do in return? Said he's going to pay 25 million, the fair value. $25 million. What now happened? I will now reassess. I will reassess. What happened at reporting date, TOC, which is the reporting? 3 things can happen. The first one, meet targets. Three things, meet targets below these are the 3 things. Have you not seen people who say, my sister, I will marry you, provided I give you belay? We tell you, I will marry you, provided you get belay. If you get belay, meet targets. You know, get belay below targets. You get belay with 3 pikin inside, exceed targets. The question will tell you all the 3. Anyone who wants you to use, it will tell you. 3 cannot be in the question. But anyone the question want to throw to you, they will give you anyone. Just know how to go about it. If it is meet targets, cost of investment will be debited, then liability will be credited. That is 1. Secondly, below targets. The question will tell you, initial promise will go to the cost of investment, debit. Equity shares, retain any of the parents, credit. The liability will be credited. That is below targets. Initial promise will go to the cost of investment, but it does not pay out to that liability. It will credit his account back. Then for this, exceed targets, cost of investment, initial promise, retain any of the parents, before that debit, the liability will be credited. Those are the three ways it can come in exam. Ask me a question. Which one does the question give to us? Which one does the question give to us out of the three? We are you to read and tell me. Which one did they give us out of the three?
Below target.
How do you know it is below target? How do you know it's a below target?
Because the fair value at at the beginning was 25, but at date of consolidation it was 22. So it's reduced. They didn't meet up to
Yes.
target.
Exactly, my sister. Where you have analyzed it is the same way anywhere in the world. That is applying FRS 3 business combination. Shall pay you 25 million. They will not tell you what happened at reporting date. So it is below target, as you said. What is the accounting entry? Cost of investment will be debited with 25 million. But instead of paying 25 million, I can only pay 22 million. It's my liability. So retain any of the parents' account will be credited. Will be credited. With how much? 3 million. Then my liability credited. With how much now? 22. That's all. That is all. So the total cost of investment that will be used for the goodwill calculation, I will not take all those things that goes to the cost of investment. All those things that goes to the cost of investment. Or say total cost of investment. First one is the share consideration. All those things that goes to the cost of investment, which is 39 million. The deferred consideration. What are those things that go to the cost of investment? Present value, which is 6.4. Then for the contingents, it's 25. I will now add everything together. That will give me the total. What is the figure? What is the figure?
$70,500,000.
70,500,000. That is it. That is it. So to the cost of investment now, 70,500,000 will be used. $70 million. plus the 18,000. It means well, yeah, what is the 70 million?
8,500,000.
88,500.
88.
500,000.
Well, now let's the net asset. He has not given me information on the net asset at all. So let's read. For the net asset. What did they say?
60 million, sir.
Based on 2004, the carry amount of the identifiable net assets of year flow was what? In his book of that company, total 60 million. But the fair value is this net assets total 7
70.
million. So there's a revaluation surplus as at the date of acquisition. So the carry amount of the net assets was initially 60 million. That is that. So what will now be our new carrying amount? Don't forget the net asset must be at fair value. That is it. So total net asset now. Carrying amount. So, which is 60 million. There's a surplus. Surplus of how much?
10 million.
1 million. So don't forget the net asset must be at fair value. Carrying amount now be. That is it. But they give us the tax base. We go to the question. He gave us a tax rate of 30%. About how many percent? Who can tell me what is going to be the tax base? In the book is 20%. Who can tell me what is going to be the tax base? In the
60
book,
million.
thank you, it's going to be 60 million. There's nothing like revaluation surplus in the book of the tax person. So this will create a temporary difference. Deferred tax table. Items. Net assets. Carrying amount, which is the 70 million. Tax base, which is going to be 60 million. Has it created a temporary difference? Yes. Then I will apply the tax rates. Temporary difference is 10 million. So tax expense go to the P or L, except goodwill acquired business combination does not go to the P or L. I will debit the net assets and credit liabilities. Now, tax rates, 20%. So deferred tax liability now. How do I know it's a liability? Because the
Carry
carry
amount is
amount
higher.
is greater than the tax base. So 10,000 times 0.2. 10,000 times 0.2. That will give me 2 million. What do I do to the 2 million? I will say, oh, net assets of subsidiaries, debits. The liability, credits. $2 million. So new carrying amount fair value of net assets and defer tax liability. Any issue? Any issue? So for the goodwill calculation, So I cannot calculate goodwill now. What is the value of the goodwill? It's 500 minus 68,000.
$2,500.
20.5.
Don't forget its fair value. The goodwill belongs to both the parent and NCI. And when there is impairment, they will suffer it together. So for the impairment, impairment will not be 10%. So for the treatment of impairment, when NCI is valued at fair value, goodwill will be credited by treatment of impairment. Then what do I do to that credit? That's that. $0.1 times 20,500,000.
$2,050,000.
Yes. Thank you. 3,050,000.
2,050,000. 2050,
Okay.
10,000.
That's clear.
Please clarify something.
Yeah, I'm listening, sir.
I thought that if there's impairment of goodwill, that NCI and parent will share it as per group structure.
Yes, you are right. Provided it is fair value.
Okay, provided it's fair value. Okay.
But let us know the impairment first. How much is the
Okay.
impairment? You say 10%. So the good will be credited by how much now? 10% as impaired. This is the impairment in itself. For better understanding. What is the total goodwill? 20,500,000. The question says impairment is 10%. So to know the impairment that will be
Yeah.
shared between parent and NCI will now be 0.1 impairment of goodwill now. Of goodwill. Let's put this way. So my sister was giving me figure then. He said, $20,500,000 is the goodwill. So
It's 2050.
205 like this. Now, out of this, parents will collect 0.75 of 2050. NCI will now collect 0.25. That's what we are saying. We are doing that because it is fair value. When it is share proportionate, we cannot do that. Because the goodwill belongs to parents only. So in this place, 0.25 times 0.50. So the first of us, I'll first of all credit my goodwill with this. So if you look at the question now, if I remove impairment of 2050, so this will give me the remaining fact. You can minus it there. There's no space. Then, how much is parent collecting from the impairment? 75% of this. 75% of this, what does it give us?
1,537,500.
1,437,500.
537.
537. So I will debit this to parent account. Then the remaining balance will go to the NCI. So what is the NCI portion? What is the NCI portion? 0.25 times 2,050,000.
512,500.
512,500. So this one will also be debited. Mr. Robert, is it clear, sir? But it will be a different ball game if it is share or proportionate. Because the goodwill belongs to parents. And when there is impairment, you suffer it alone. So cost of investment will still remain the same.
Alone, suffer alone.
What do you say?
I said eat alone and suffer alone.
Yes, definitely, sir. But NCI that will be here now, it is based on the net assets, 68,000 times 0.25. Because it is share proportionate. Share the net asset based on the proportion. Net asset method. So what does it give us?
70 million.
70 million again.
No, 17. 17.
Thank you, my sister. I love your swag this night. So what is the goodwill now? So 87,500,000 minus 68.
19,500,000.
19,500,000. So any issue? So this one will now give us 1 million. So what is going to be the goodwill at DOC?
$17,550,000.
That's all. So treatment of impairment now, goodwill will be credited. And that is that. That is the end of the question. Any question for me? So let's start opening everything tomorrow as before 11:30. Complex question or simple group. I will send it to the platform, package it. This is it.
That contingent consideration that we packed in liability.
Okay, let me check it. Let me put there.
Yes.
Let me sir. This is it, sir.
The contingent consideration.
These are it. What you need to know down with the condition.
Yes, we put 22 million in liability.
Because it's not paying 25 again.
Yes, but what I'm asking is, we kept it in, like, if they never, ever meet that condition, what will happen? Are we going to reverse it from liability? We can't carry it there forever.
That's what he's saying now. That's what he's saying. In short, we are still going to that thing you said. This question I asked now, we are still going to solve it in the future. Then we say, okay, it is very glaring that he cannot meet the liability. If you ask me now, okay, if I'm going to be a president in 2037 election, you are going to give me 50 million. Definitely, you are going to credit your money back to your account.
Because we're holding it there, thinking that they will meet it, then we can pay them from that place. But if they don't meet it,
if you don't meet it, I will just move it. I will do what? Debit it there. Because it's a liability, which we assume it has exists as at the date of acquisition. If you don't meet your liability again, I will just debit and credit my retaining back, just like we have done this way. Then if it surpass liability, it's just an estimation. So the actual event is what we reassess. Is it clear, sir?
Yoga.
What do you say?
No, I say I'm thanking you for explaining it.
Thank you, sir.
Thank you, sir.
So now, always remember that when it is fair value, what makes the two figures to be different is because one is valued at fair value and the other one is at share proportionate. That is it. One, it is at fair value. We will test the ground with simple question now. But next week, we are going to increase the complexity of the question. I will send all those complex questions to the platform. But I want us to go on gradual basis. Then the goodwill calculation, you can do the remaining and send to me. I will send the solution. Okay. Then let us introduce impairment today. So from next week, we know that we are going to be solving full-blown questions. I don't know whether you have done that year 36. Year 36. Have you done year 36 with
We have not done it.
Okay, let's wait then. But when we before we get to that kind of question, we will see. Okay. Now, let's take question we can solve on that one now. Let's take higher question. Go to question. Super copy is too simple. Which one is this? Let's take 30 December. Okay, let me give you option. Pick between 30 December and I think that one. Or Bola. So that we can solve between 1 to 1.5 hours. Let me start sending this while you make your options. Immediately I give you the question in exam, for easy sake, you open everything. I will show you the account to open. Oh yeah, look at it and pick your choice. I'm waiting for you.
Higher.
Final answer, Aya. Let's see. Aya. Final answer. Somebody said Aya. Mr. Robert, do you go with that?
Yes. But it depends on which particular question you feel is good enough for us. That has so many things we
You
can,
will know
we can
everything.
learn from.
They just start. You will know everything. I'm very sure. Very soon you will know everything. This one, okay, these are simple group. Because it going to something. Okay. Let me quickly send this before I clear my board. So that I'll go back to watch that.
Sorry, guys. Sorry. What question number is this? Sorry. Question what?
Which one?
I don't know. My sheet is. I don't know if it's scattered.
Somebody should help us.
What question number? What, please?
Page 25, like the last page or second to the last page. That's where you find it.
Okay, thanks.
So
Page 23.
The baller has contingent consideration. There have been a lot to learn from there.
the one I got, so I will send the solution so that you go and check it.
Because higher has only the only thing that is higher has share exchange.
If the class want to change their mind, is it
No,
allowed?
you decide, sir.
No.
The higher has share exchange. Baller has contingent consideration.
There's nothing we see no. Me, I'm very sure. We will see know everything. We're going to solve a lot of questions. Now that we have, at least we laid the foundation. Let me save this down. So I'll send those solutions to the platform. So what do you say is the final one now?
Let's just do the now instead of dilly-dallying. Since we're still going to.
Yeah, final answer. Let us go to the requirement of the question. The question says we should consolidate statement of profit or loss, statement of financial position, statement of change, that's true, and statement of consolidation for statement of profit or loss and SOP, the balance sheet. In exam, I will open everything to make it faster. What are the things to make open? The revenue, I will say, okay, aya. Say consolidated statements of profits or loss for the year ended. For the year ended 30th September 2017. Don't forget, I will not start from this revenue. Cost of sales, gross profits, distribution, cost, admin, expenses, finance costs, then profit before tax. That's profit for the year. That's all. I will not put figure, I'll just open down. I will now go to statement of financial position, which I'm going to start with. I will also consolidated statements of financial position as at 30th September 2017. 30th September 2017. No current assets. PP. One to 200 plus 403 200. I'll open the goodwill account. Goodwill. After the goodwill, I will leave 2 or 3 line space because of those things that can come there. We'll go to the current assets. So if I want plus 200 total assets, equity and liabilities. Equity shares, equities and liabilities. Share capital. Retain. Please, after the equity and liabilities, after the equities, always leave a line space before the NCI. Go to the current liability. the current liability, non-current liability, yes. Okay. Non-current liability, 10% loan notes, 96,000 plus 128, then current liability. We have this is 2 plus that's all. To balance this accounting exam, what do I need? To balance this accounting exam, what do I need? 1, I need good structure. 2, adjusted retained earnings of subsidiaries as per statement of financial position. I need to determine the net assets. I say determination of net assets of subsidiaries. We'll say items, DOA, DOC, and post. I need to calculate the goodwill. I need to calculate the goodwill. For the goodwill calculation, I'll open the formula. Goodwill. Cost of investment. Add NCI. Purchase consideration. Net assets at the date of acquisition. Goodwill. I don't know whether there's going to be a payment. I will list. I'll go to the retained earning. Sale of the parents. As per SOP. Then I need to calculate NCI. I will open everything down. NCI. Date of acquisition. Then for the POL, it's only major thing that we used to calculate majorly is the cost of sales. We say cost of sales. That's all. This is what I would do in exam. This is what I would do in exam. For doing this, how many marks are you going to give me? Let's say you are my examiner and you want to score me. How many marks are you going to give me for doing this?
Five over 30.
5 over 30. Somebody is talking. 5 over 30. Okay. It's not the mind that even matters. It will give my job direction where I'm going. I will just be reading and be posting. Okay. Don't forget those two we have learned. Say, okay, goodwill. Cost of investment, NCI, net assets, date of acquisition, and the rest. This was this. I will now start with the statement of initial position. I will do as if I did not see the P or L. I will now start with, okay, let's read now and start posting. So the question says, okay. Okay, the question says, on 1st April 2017, what happened on that day? Acquire 60%. Oh, date of acquisition. The date of acquisition. Now, when did you choose this? Date of acquisition. Said on 1st April, date of acquisition. 1st April 2017. When are we consolidating? We are consolidating 30th September 2017. How many months account this during the year? Acquisition. Don't forget, retain any. Retained any of subsidiary will not be given into situation. One, during the year acquisition. When acquisition is less than 12 months. Two, at incorporation. These two ways, nobody will give you retain. When it is during the year acquisition and at incorporation, so no retain any at the date of acquisition of subsidiaries. One, during the year, which I will apply formula to get. But at incorporation, the question will tell you it just started to work, they acquire. It is 0. Retain equals 0. How do I know it is during the year acquisition? When do you acquire? It was acquired 1st of April 2017, and they asked me to consolidate 30th September 2017. So during the acquisition, no retain. So what is normal duty in exam? I will determine the retain. When we get there, you see. If I don't know how to determine the retain, I cannot get the net asset at the date of acquisition. He said he acquired 60% of equity share capital of Lower. I'll go to the question to go and fill in the gap. He acquired 60%. 60%. Parent. 60%. NCI. That's all. I'll go for that. How does it pay for the 60% equity share capital? All right. In a share exchange of 2 shares in IIA, for 3 shares in 2/3, he has given me exchange ratio, which is 2/3. I'll go to the question, but I need to know what is the total numbers of shares. I need to know first. Okay, total numbers of shares in subsidiary, because the values of shares all over nominal value. What is the values of shares in subsidiary? Go to the question, 128,000. Nominal value is ₦1. He only acquires 60%. This is at 100%. So 0.6 times 128. 0.6 times 128. 0.6 times 128.
76,800.
Good, 76,800. How does he pay for the 76 share exchange, share consideration? Parents over subsidiary, 2/3 times 76,800.
51,200.
51,200. It must be issued at the market price per shares of the parent. Cost of investment debits. Go to the question, what is the market price of the parent? Because the rule says it must be issued at the market price of the parent. Unless the market price of the parent cannot be determined, I will not use that of the subsidiary. What is the market price per share of the parent?
6.
Cost of investment times 6.
307,200.
307,200. Equity shares must be credited. Give me 51,200. Then share premium to be credited.
$256,000.
This is the normal accounting entry to post. I will now ask the question for each cost of investment in exam. Has it been recorded? We are asked the question always, my brothers and sisters, either you are redrafting or they ask you to consolidate. You must ask the question, has it been recorded? We are asked that question, has it been recorded? We are asked the question, We are asked the question, has it been recorded?
No.
No.
How do you know it's no? It's only 3 ways I can know whether it is recorded or not in exam. It's only 3 ways. Let me show you the 3 ways. Whether if a particular cost of investment is recorded or not. 1, when the question is silent, it means it has been recorded. When you see that the question did not say anything, go to the investment, but you see that it has been recorded. 2, clearly stated that it has been recorded or not. The question will tell you. Third one, through investigation. These are the three ways you can know it is recorded or not. When the question is silent, it's recorded. But it will clearly tell you if it does not want to disturb you. And third one, through investigation. Now that it has been recorded or it has not been recorded, what is my duty in exam? You must know all the accounting entry for each course of divestment. That is one. So that you can post. Two, you must be able to differentiate between recorded and recorded, and what is accounting entry to post when it is recorded. Three is that failure to know the truth, no problem. Ask me a question. The third one is the failure to know the truth. We have a problem. Yeah. Ask me a question. So for this, you said it has not been recorded. Cost of investment for my goodwill calculation, I will debit. For my goodwill calculation, I will debit. 307. Equity shares, I will credit. Go to the question. Share capital. I will ask the question. What is the share capital in the question before? What is the share capital of the parents? 320 plus 200 credits. There was no share premium. I will create share premium. That is all. I have recorded 256 share premium account. I'll post it 256 share premium. That's all. It has not been recorded. I have recorded it. Cost of investment will be debited. Equity shares will be credited. Share premium will be credited. If there's no share premium in the question, it must be created. Any question for me? Please give me a minute. Let me take it. Any question for me? Any question for me? We go to the question. That is gone. Oh, yeah. I will read further. Don't forget, you only acquire for 6 months. Additional information now. At the date of acquisition, the fair value of Lower Limited assets were equal to the carrying amount, with the exception of the items of plant, which had a fair value of 64 million in excess of the carrying amount. In excess, 64. In excess of the carrying amount. 64. In excess. What do I do in exam? Adjustment number 1 in this class. The first adjustment. First adjustment. What do I do? In all the majority of the question, there must be fair value adjustments, which can come in exam in 2 ways. It's either the revalue up that give a revaluation surplus, or the revalue down that give revaluation deficits. How do I know in exam is a surplus? The question will tell you in English term. Above, higher, like this one. In excess, they will tell you below, lower, expressly stated. Secondly, they will give you carrying amount and the fair value. If carrying amount is 10, fair value is 15. That means there is a surplus of 5. The other way around, it will come with deficits. And the last one, which is very real, they will just say the fair value of the PPE. You go to the financial statement and look, what is the carry amount of the PPE? That is it. Any issue? So if it is surplus, what is the accounting entry? After I've noticed it's a surplus, what do I do? PPE, debit, I will add. The reserve, credit, with the surplus. But if it is deficit, opposite, PPE, I will credit. Don't forget, if you are crediting PPE, you are removing. Then the reserve, I will debit to remove. Then it will create a depreciation issue. Depreciation, I'll get the surplus. Then from the date of acquisition to the date of consolidation, then what am I going to post? I will now say PP credit for the depreciation we have used. Adjusted the earning of subsidiary, I will debit. But if it is deficit, PP debit, reserves, yes, PP debit plus, then adjusted return. Adjusted return of subsidiary credits. That's all. That is all. That is all. Let's pause this to see. We shall 64 million, fair value of 64 million in excess of the carrying amount. So I'll go to my PPE. We'll go and debit. PPE plus 64. I will go to the reserve of the company. Credit reserve. What I've opened up, share capital. The net assets. Look, see here. Share, I'll pay the share capital, which is 128,000. Retail earning on new yet. Revaluation surplus on PPE. 64. That's all. Our credit reserve. Any issue? Any question for me? Then the depreciation on the surplus. What is useful life as at the date of acquisition? Oh, now depreciation now. 64 is the surplus. Divided by the useful life times from the date of acquisition to date we are consolidating. What is the useful life of the asset as at date of acquisition?
That is 6 months again.
6 months is the period of consolidation.
Yes.
5 years. Times 6/12. 5 years times 6 to get the depreciation.
64.
6/4. What do I do to the 6/4? PPE credit. Just return. That's all. That's all. I'll go and post. Credit. Just return. Finish. Next. Secondly, the sales of lower limited to higher limited in the post-acquisition, it must be post. In the post-acquisition period about 256. What do I do to that? Intergroup sales. Intergroup sales. I will eliminate from revenue. You cannot sell to each other, you are a single entity. Go to the question and say revenue, debit, revenue. With 256,000. Credit cost of sales. With 256,000. You cannot sell to each other. So revenue. Oh. Let's finish this question. Go to the question. What is the revenue of the parents? My sister, help me, I beg.
$2,720,000.
Thank you, my sister. 2,720,000. Plus that of the subsidiary.
1,344,000.
1,344,000 times 6/12. Intergroup sales minus intergroup sales of 256. Why do we put for 6 months? We only acquire during the year for 6 months, from April to September. So all items in the revenue and income should be prorated. So I will go to the cost of sales. What is the cost of sales of the parents?
Two
My
million
sister.
sixteen.
1 million.
2,016,000.
2,016,000. Subsidiary cost of sales.
1,024,000.
1,024,000.
24,000.
times 6/12. What does it give us? What does it give us? I will now remove it out.
512,000.
Huh?
512,000.
512,000. Intergroup 6 now. That is the first thing when they give me intergroup 6. Next, is there any unsold? And if you say margin or markup,
Markup.
Markup.
Because it's so
markup, is there any unsold?
What is
yeah.
Look at it. What is the total sales? It's 256. Now the total sales is 256. Out of this total sales, how many million has been sold? Sold.
166.4.
So I can get the value of unsold now.
89,600.
Huh?
89,600.
It's 9,600. It's a markup. So to eliminate unrealized, so this is the unsold markup. %40. If it is 40% markup, unrealized profits on inventory now equals to 40 over 100 plus 40 because it's a markup times unsold. That's all. That is all. Where's the figure?
$25,600.
What do I do to 25,600? I will debit the seller and credit consolidated inventory. That is all. So I will debit the seller. Who is the seller? We are check.
Lower, lower. Lower, lower is the seller.
Lower, lower. Who is lower, lower?
The subsidiary.
So the subsidiary is the seller.
Yes.
So I'll go to account of the subsidiary and remove the money. So seller account, let's go and debit. Seller accounts and credit consolidated inventory. This seller's unrealized profits on inventory. 25,600 debits. As per SOP, what was the return of the subsidiary?
$208,000.
Consolidated inventory now. Go to the inventory. There is no inventory, but there is current assets
An item.
minus. That's all. But if it is shop opportunity, next. Any question? What is the time? You cannot finish this question this morning.
It's 11
See
already.
the and this. So I will send this question. We'll continue next week.
Alright, sir.
By God grace. How many additional information does it need?
Three.
Let's continue next week. Let's complete it next week.
What terms?
Let's complete it next week. So good night. Next week we will start over again and complete then we'll pick another question which is going to be more complex. I will send those one tomorrow.